Matewa, Daniel. The Reserve Bank will release its latest review of the official cash rate this morning. Economists are agreed it's unlikely to change, but not for much longer. So what do looming interest rate hikes mean for homeowners and those looking to get on the property ladder? Joining us this morning is the Chief Executive of the Property Institute, Ashley Church. Good morning, Ashley.
Good morning, Hilary.
Do you, like most other economists, agree that the OCR won't be going up today?
I do. I think it'll stay at 1.75 today, and there's three reasons for that, Hilary. The first of them is that although inflation's increased, it's now sitting at about 2.2%, in fact exactly 2.2% annualised. That's pretty much in the sweet spot for the Reserve Bank. They've got a range of 1 to 3%, so you could actually argue that if that's what 1.75 OCRs are achieving, then that's where you would want to leave it. The second one is that the OCR has a bit of an impact on the rate of the New Zealand dollar, the value of the New Zealand dollar, so the Reserve Bank's always very cautious about increasing the OCR because it increases the value of the dollar at a time when they actually want that dollar to decrease. And the third one is that the Reserve Bank at the moment believes that house prices have stabilised, so they're unlikely to want to do anything with the OCR given that they think that they're now in a reasonably sweet spot with regard to house prices.
Certainly mortgage rates are going up anyway,
yes, putting
the OCR aside. How is it affecting homeowners at the moment?
Well, that's an interesting question. So as you say, there used to be a direct connection between the OCR and interest rates. Banks would tend to move in relation to what happened with the OCR. That connection's kind of moved away over the last 12 months or so, and the banks have got a range of other pressures on them that are forcing them to increase rates anyway. One of those is a requirement or a self-imposed requirements by the bank, so since the GFC, to try and fund as much of their funding as possible from within New Zealand. So they used to fund, prior to the GFC, they used to borrow money overseas, and so when the GFC hit, obviously there was a relative risk to the New Zealand and indeed the Australian market. What they try and do now is get as much of that money from within New Zealand, and the impact of that is that obviously there's a limited supply of money available from New Zealand depositors. That means they have to pay more. If they pay more, they also have to charge more. And so what's happened over the last few months is that you're starting to see a little bit of an increase, and you can expect to see that continue over the next 12 months, and we're thinking probably anywhere between 0.75 and 1%.
You mentioned before that the market is slowing. Is this something that's going to last for a long time? Is this the start of a correction?
Yeah, look, that's an interesting question. Our view's consistently been quite different to other commentators, and that is that this slowing is a blip. And the reason for that, and we're talking particularly in relation to Auckland and those faster growing markets, and the reason for that is because the fundamentals that were driving house price growth are still there, Hilary. They haven't gone away. So immigration's still strong at just over 70,000 this year. The shortage of houses in Auckland of anything up to 60,000 is still there. So our belief is that the slowdown at the moment, to the extent that there is one, has been driven by things like the LVR restrictions, etc. And essentially it's a little bit King Canute-ish. You can slow things down for a while, but you can't slow them down forever. So to the extent that there is a slowdown, we don't think it's sustainable.
It is remarkably unaffordable to own a home. Of course, we had the figures out yesterday
we did.
From the government. And the worst statistic was in Auckland. 86% of Auckland renters can't afford to buy a house. Did that surprise you? Does it concern you?
No, and it's interesting to note that that report didn't actually create the issue. All it's done is it's shone a light on a situation that already existed. And to some degree, that report, that housing affordability measure really just indicates what's already in place. Didn't really surprise me. And that situation's compounded by the 20% deposit that's required for first-time buyers, and in fact for anybody buying their first home, which actually wasn't measured, Hilary, in that report because the figures predate the imposition of those deposits. So the situation's actually worse than that report indicates.
And the government giving some indication that it might tinker around with the KiwiSaver Home Start grants just to help people out. Would that be a good idea? Well,
yes, it would, but it is only tinkering. The things that are really going to change that are things like dropping the LVRs on first-time buyers, and we've been hammering on about that for about a year. We still think that's really important. And also looking at doing things that are going to encourage the private sector to get involved in the construction of new homes, because the only way you're going to fix this problem in the long term is to build lots of new houses as quickly as possible.
Property Institute CEO Ashley Church, thanks for your time this morning.
Just coming up to 7 o'clock, getting to the bottom of the dirty water issue.